Now, we've all heard about investing, and I'll agree it's a little overwhelming at first, but so is crossing the road, and then again so is driving. You crawl before you walk, and you take lessons before you drive. When it comes to investing, we won't take the time to stop and read about what best suits us, our lifestyle, our budgets, our direction that we want to go in life, and we instead impulsively invest in get-rich-quick schemes, stuff that never ever ever works. I'm sure you've heard about the crazy gains that everyone's made from stuff such as Forex.
Why you always lying?
And maybe even day trading.
It's false. No way. Not this time. It's totally made up.
And yes, it's probably worked for a very small number of investors, but if I were a betting man, I would say a lot of people parted with their money pretty fast. And the reason being is headlines in newspapers do not dictate the markets. Even the economy doesn't dictate the market. Headlines dictate an emotional response to how we part with our money. Stock and current market price is all that matters. See, investors, you and I, we select funds based on past returns only. Sometimes a stock track record happens by chance, and lightning usually never ever ever strikes twice. So when you get, let's call them money managers, saying that they can predict where a market is going, the first thing that we're going to do is look at their past results, like they've had some informational advantage on the market. The assumption that strong past performance will continue often proves faulty, leaving many investors, you and I, disappointed. If the greatest economic minds can't dictate where a market is going, why do you think some guy in an iPhone in his boxer shorts looking at graphs can? Stop playing games that you don't know how to play. You're losing money. I think it's clear that pretty much all get-rich-quick schemes don't keep up, and short-term outperformance fails to repeat. So many investors like you and I end up disappointed. We've all heard that if we put X amount in when we were 2 years old to this index fund, we would have had X amount now. Well, we didn't. Now what? A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. This entitles the owner of a stock to a proportion of the corporation's assets and profits equal to how much a stock they own. Units of stock are called a share. An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. For example, one share of an index fund based on the S&P 500 provides ownership in hundreds of companies. Now, let's say this rubber duck is one big fat stock you've heard some whispers about. And say this ball is all your money. You shoot your shot, the duck didn't even move, and you've lost all your money. Now, say these ducks represent an index fund. Instead of placing all your money on one big fat duck shrouded in hearsay, you shoot your money over a diversified portfolio of, let's say, the FTSE 100. One or two stayed the same as the others went off the chart, and moving forward, it balances it out. Now, I'm aware that everyone's circumstances may differ, but investing a small amount today at least gets you started and in the mindset for long-term growth. As the great Jack Bogle says, why look for a needle in the haystack when you can simply buy the haystack? You missed out on Tesla and Apple stocks. That's unfortunate. Index funds that track the S&P 500 didn't. Another thing that I want to point out is I have a very active life. I do not have time to babysit opening, closing, buying and selling stocks. So right now, this level of passive investing suits me just fine. And plus, why play against the professionals when you can get the professionals to play for you? It must only take half a percentage, rather than a financial advisor that would never talk about index funds and take 5% of what you would get. So you don't really need one at all, ever. If you are moving big money, then no, index funds maybe are not risky enough and high yielding enough for you. You would then be best to noise up an FA. You want your money to make money. Okay, We start now. We drip our money in slow and steady, 50, 100, £500 a month, whatever fits your budget, to your lifestyle, into your index fund. And over a long period of time, your pot will build up, with the nature of the world always increasing, added with compound interest. Personally, I reinvest my dividends automatically. I kind of set it and forget it. But there is options to pull out passive income wages from your index funds. If you needed the money or you were retired, then you would maybe look at bonds, something that actually gives a good income. That's another video. And of course your overall gain would then go down quite a bit. You kind of want to hold on to these funds for as long as possible. Pandemics, recessions, depressions, dot-com bubble bursts, the stock market has continuously got back up to where it once fell from and kept climbing. In fact, February and March, with COVID taking grip of the planet, the stock market recovered 70% faster than the economy, which is still rising in November 2020, which clearly shows that the stock market is increasingly divorced from the economic reality. Still, the market retains its grip on the collective imagination. The current economic fallout, however, could snap any illusions that the logic of the market is derived in any consistent way from real-world events. Another thing to note is I live in Scotland, and so my first thought would be to look at the FTSE 100, which tracks the 100 biggest companies in the UK. Royal Dutch Shell, HSBC, BP. However, from what I've learned in the past 2 years is that home bias can actually hurt my investing. See, right now we have Brexit uncertainty, and despite the fact that many companies in the FTSE 100 are multinationals that generate a significant proportion of revenue internationally, right now many global investors will steer clear of the UK equities due to economic and political uncertainty here in the UK. And so this is why it's very important to fully diversify your portfolio so your returns are not underwhelming. There is no universally agreed upon time to invest in index funds, but ideally you want to buy when the market is low and sell when the market is high. And since we don't have any magic crystal balls, the best time to invest in an index fund is now. Drip the money in slow and steady, like the book Tortoise and the Hare. Slow and steady wins the race. Every time I read that book, the tortoise wins. Now, on the next video, we'll talk about different platforms to invest in index funds and different type of funds available to us. I hope you've got some value to this. We do have a long way to go on our roadmap, but I'm pretty confident we'll get there.